June 15, 2017 was a bad day for Kroger. America's largest supermarket chain, losing its fight against Amazon, Walmart, and other competitors, slashed its guidance, sending shares down 19%.
After listening to today's conference call, one can only conclude that supermarkets are now in one gigantic race to the bottom, and no one will come out unscathed, perhaps least of all Kroger.
But as bad as that day was, June 16 was much, much worse. Amazon announced its acquisition of Whole Foods. The news wiped roughly $40 billion off the market cap of the retail food industry.
Amazon to buy Whole Foods. You know, yesterday was a day for Kroger that was tough. Today will be an even tougher day. This is a game changer. This is it. This is what everybody thought could happen. They will now dominate food within the next 2 years. Wow.
Suddenly, the world had changed for the more than a century-year-old grocer. Kroger's origins date back to 1883, when Barney Kroger opened a grocery store on 66 Pearl Street in downtown Cincinnati. The store, then called the Great Western Tea Company, began Kroger Grocery and Baking in 1902. Kroger quickly established himself as the first grocer to offer in-house bakeries and meat departments. It saved money by making its own goods, like bread and sauerkraut, rather than buying it from third parties. The chain grew slowly but surely over the next 2 decades. 40 stores in 1902, 157 stores in 1912. In 1917, Kroger bought 4 chains in Detroit comprising 125 stores. Deal-making would go on to be a hallmark of the retailer's existence. Kroger's acquisitions revved up even further when Mr. Kroger stepped down as president in 1928 and was replaced by William H. Albers. From the spring of that year through the next 16 months, Kroger bought 28 chains and 1,838 stores, including Piggly Wiggly. It was fueled with capital from Kroger's ballooning share price. The deal spree brought Kroger's footprint up from roughly 5,600, growing it by more than a third in just 2 years. Kroger also learned, after some stumbles, the important art of moving slowly in integrating its acquisitions, allowing grocers to maintain their identity by keeping management teams in place. Through acquisitions over the next few decades, Kroger moved into California, Texas, and Charlotte. By the 1980s, it was the country's second largest grocer. But the 1980s brought a new competitor and a new game plan. Walmart opened its first supercenter combining its discount stores and grocery in 1988, creating a powerful new rival that combined Walmart's cheap prices with the convenience of a grocery shop. This new competition was particularly difficult for grocery giants like Kroger, which in 1988 had 1,300 supermarkets in 20 states and 935 convenience stores. Its size, once a strength, limited its ability to react quickly.
I would say that Kroger came through Walmart pretty well compared to many of its competitors. It really understood that the economies of scale in the supermarket business are not so much being big nationally, but being big locally. And if you've got a 40 or 50% share of a local market, you can defend that pretty well.
The grocery industry wobbled, their stock prices fell, and private equity buyers pounced. In 1986, the country's then largest grocer, Safeway, fell prey to private equity firm Kohlberg Kravis Roberts & Co. The deal made Kroger the country's largest grocer as Safeway began to downsize. It also made Kroger KKR's next target. KKR launched a bid for Kroger in 1988, but the grocer that built itself up through acquisitions was unwilling to let itself become bait. Kroger rebuffed KKR's offer with a restructuring program that promised a special dividend of $48 a share, which the grocer would need to fund by loading on debt. The rebuttal ensured Kroger's freedom. Now, it had to prove itself worthy. Over the next decade, it poured money into redoing its stores. It invested in its store brands, growing its private label brand Simple Truth to $1 billion in 2014. It battled Walmart by not just focusing on price, but also on product and service. All the while, it continued to gobble up competitors, including its $13 billion acquisition of Fred Meyer in 1999. The strategy worked. Kroger enjoyed 52 consecutive quarters of same-store sales growth into the 2000s, until, once again, its competitors got better and stronger. In 2017, Kroger's growth streak ended. Consumer tastes had changed. People now preferred organic and natural food. Grocers like Whole Foods had popped up, catering to that need. As a result, the competition had to get better. Walmart began to make its stores nicer and stock them with higher quality merchandise. The same went for Publix supermarkets, Ahold Delhaize, and Sprouts Farmer Markets. European discount stores, Aldi and Lidl, threatened expansion into the U.S., offering a new competitor who could fight on price alone. Then, Amazon came along with the knife. Amazon's acquisition of Whole Foods upended the grocery industry and changed the game. More stores would not protect Kroger from Amazon's might. Amazon brought with it the threat of a powerful membership program in Prime, technology, and automation to pair Whole Foods store base and an investor set that didn't bat an eye at investing at the expense of profit. The deal sent a jolt through the grocery industry. It compelled already powerful players like Walmart to fuel even more resources into technology and delivery. 70% of shoppers will be buying some portion of their groceries online within 5 to 7 years, according to Nielsen. That equates to $100 billion in total sales. Walmart is re-outfitting its stores to support grocery delivery and racing to bring it to 1,600 locations by the end of fiscal 2020. Retailers like Target, which struggled with its grocery business, have been forced to quickly make bets. Target paid $550 million to buy same-day delivery service Shipt in 2017.
I think everybody in the business is threatened by serious changes in consumers' preferences. And the retailers really don't know how to deal with this. So it's not just a question of Amazon and Walmart being its biggest threats. There are home delivery services that are significant threats to Kroger because people are choosing to have dinner delivered rather than making dinner themselves.
Those changes are forcing Kroger to shift course. Buying more stores won't help it adapt. Instead, Kroger has begun to furiously invest in technology. It bought meal kit company Home Chef and a stake in British online supermarket Ocado. It launched grocery delivery service Kroger Shipt and struck a partnership with driverless car company Niro. It inked a partnership with Walgreens in the U.S. and Alibaba in China. Some of these investments appear to have borne results. Its digital sales grew more than 60% in the third quarter of 2018. But that growth came at a cost. Its profit fell 20%. Whether the sacrifice was worth it is yet to be seen. While investors wait, Walmart and Amazon are pouring their own money into winning the grocery game. Barney Kroger's vision to make his own products and offer more in his stores helped fuel the grocer for the past century and a half. Whether that legacy can match the titans from Seattle and Bentonville is yet to be seen.